So before I give you guys some advice on this topic, I just want to let you know that this video was actually an idea that was suggested to me in a recent post that I sent out. My goal is to help you guys with any questions that you have. So if you could, drop some comments in this video telling me what your biggest problems are right now with investing. And I'll make a video on it if it seems like most people could get the help they need from it. But from this video though, I want to go over whether or not you should be buying a stock after a huge surge in price. Meaning, have you ever seen a stock that's up maybe like 20, 30, or even 50% and wondered if you missed your chance to get in? I mean, it can honestly be pretty hard to tell sometimes if you should start buying now on the chance it keeps going up, or if you should just wait it out in hopes that the stock falls back down a bit. So I want to talk about how I think about this and how you can figure out whether a stock that just surged is actually worth buying or if it's a trap. First off though, I want to be clear about something. Price action alone doesn't tell the whole story. So just because a stock goes up fast doesn't mean it's done moving. But it also doesn't mean that you should chase it blindly either, right? Because in the past, I've definitely had my fair share of panic buying to try and avoid FOMO. But I've also been on the other side as well, where I've refused to touch a stock because it's already gone up too much. And neither of those is a real strategy. So here's a better way to think about it. You want to zoom out and ask these three things. Has something actually changed in the business? Does this surge make the stock overvalued? Or is it just catching up to fair value? And most importantly, does this move have follow-through potential? Meaning, is it the beginning of a trend or the end of one? And make sure you stick around for this whole video so I can give you the gold standard of signals to watch out for so you know exactly when to buy using absolutely zero guesswork. So when thinking about these three things, it's always better to zoom out and see the bigger picture. Let me give you an example. A couple years ago when Palantir ran up from like $6 a share all the way to 18, I'm positive that a lot of people probably saw that and were thinking that it was too late to get in. But for me personally, I didn't sell a single share and I actually started buying even more shares because my conviction wasn't based on the price alone. It was based on what the company was doing, meaning onboarding government and enterprise clients, expanding their AI platforms, and finally shifting into profitable growth. Basically what I'm saying is that surge in the stock wasn't random. In my opinion, it was rooted in fundamentals catching up with the long-term narrative. And since I understood what I owned, I just held on to it. And it kept climbing, even soaring past the $100 share price. Now, I want to pause here and address something that's maybe a little more practical. There are technical signals that can help you time entries after a surge. In fact, there's something of a gold standard for bullish indicators that's widely considered to be one of the most reliable and universally respected bullish technical signals, from everyone from momentum traders, growth investors, and even long-term institutional players. So I want to break this down clearly. If you've been following this channel for a while now, you'll know that I don't build my portfolio around technicals. However, there are some technicals that are important to be aware of so that you can have a broader understanding of how the stock market generally operates. And one of the most well-known is the breakout above the 30-week moving average. The idea is when the stock breaks out above its long-term average price over this 30-week period and there's strong volume, especially after long consolidation, it's usually the beginning of a bullish trend. However, there's another indicator that's even more reliable and more simple to understand without needing your stock platform to compute or draw a moving average. The one I'm about to mention is considered the gold standard, and it's the breakout above the 52-week high. So I know this sounds counterintuitive, but hear me out. You'd think a stock hitting an all-time high means that it's too expensive, but historically, breakouts to new highs, especially after periods of base building, can actually signal strength, and momentum works when the story supports it. Now, let me be clear, none of these are guarantees, but if you're trying to decide whether to buy after a big move, these tools can help you avoid buying at the peak right before a collapse. However, please don't click off this video yet, because there's an extremely important caveat to all of this. Most respected investors don't consider a stock breaking the 52-week high by just a few cents as a strong bullish indicator. That's often seen as a fake out or a weak breakout. So what you really need to look for is a clean break with a strong close above the 52-week high, meaning the stock should close above the previous high, ideally by 1 to 3% or more. Keep in mind though, that after the breakout, the stock may reset to the breakout level. If it holds though, that's extra confidence for you. And along with this, a lot of traders also look for a volume spike on the breakout day, at least 40 to 50% average volume. This shows that institutional buyers are stepping in. However, I'm not a trader, and I assume most of you guys aren't. So I'd say for a majority of long-term investors, it's okay to skip looking at volume in this case and just focus on the 1 to 3% spike above the last 52-week high. In fact, instead of focusing solely on volume, which you still can do if you want to, I'd actually pair the 52-week high with going back to your thesis and checking if the fundamentals of the company have changed. If they haven't, then you have the makings for a great entry point. However, this isn't everything. If you combine everything I just said with another specific pattern used to identify stocks before they take off, then making above average returns in the market becomes insanely easier. Watch this video next to understand what this pattern is and how you can practically apply it. Anyway, thanks for watching, and I'll catch you next time.